This meeting of the board is a hybrid physical virtual meeting. I would like to welcome those in the boardroom with me today. While keeping your microphones muted, please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America, to the republic which stands, one nation, under God, indivisible, with liberty and justice for all. At this time, I will ask the secretary to the board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting. Chairman Logan, Board Member Hall, and Board Member Smith. Your microphone should normally be muted except for board members and presenters. Please ensure that you have silenced any mobile devices that you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have 3 OIT staff, Ricardo Matos, Victor Amaya, and Ben Rana, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you are an FCA or FCA staff member, you're considered a panelist. The outside visitors are considered attendees. Everyone will see the slides as they advance. If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Logan, that concludes the technical and protocol items. We're ready to continue when you are.
Thank you. The secretary will now read an opening statement on the Government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Logan will entertain a motion to close the meeting.
Thank you. We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
Move to adopt the agenda as published.
I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall?
Aye.
Mr. Smith?
Aye.
Chairman Logan?
Aye. The motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
Mr. Chairman, the agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Mr. Hall?
Aye.
Chairman Logan?
Aye. The motion carries. Please turn to tab 1. The next item on the agenda is the approval of minutes as presented behind tab 1.
Mr. Chairman, I move to approve the minutes for the June 13th, 2024 regular board meeting as presented.
And I second that motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall?
Aye.
Mr. Smith?
Aye.
Chairman Logan?
Aye. The motion carries. Please turn to tab 2. At this time, I will ask Shara Pollard and David Lewandowski of ORP to present the update on Farm Credit System funding conditions. This is an information item.
Good morning, Chairman Logan, Board Member Hall, and Board Member Smith. My name is Shara Pollard, Senior Policy Analyst with the Finance and Capital Markets team in the Office of Regulatory Policy. With me this morning is David Lewandowski, Senior Policy Analyst on the Finance and Capital Markets team. Thank you for the opportunity this morning to provide the Office of Regulatory Policy's periodic public update on the Farm Credit System's funding. Before our update on the funding conditions, I wanted to provide a brief background on the Farm Credit System's funding process. So the Farm Credit System primarily obtains the funds for its lending operations from the sale of system-wide debt securities through the Federal Farm Credit Banks Funding Corporation, which is the fiscal agent for the 4 farm credit banks. Debt issuance must be approved by the Farm Credit Administration, subject to certain criteria. And debt securities are the general unsecured joint and several obligations of the system banks. They are not obligations of or guaranteed by the U.S. government. The Office of Regulatory Policy is responsible for day-to-day operations of funding approvals and related functions. The funding approvals team in the Office of Regulatory Policy maintains a program for the efficient and timely processing of funding approval requests, typically in a few hours or less. This team is also responsible for monitoring activities, periodic reporting, and other controls, and we coordinate heavily with the Office of Examination and the Farm Credit System Insurance Corporation on funding-related matters. At this point, I'm going to provide an update on the Farm Credit System funding conditions, and then I'll turn over to David. So I'm going to start with an overview of current financial headlines. And I'm just waiting for the slide to advance. Thank you. Go to the next slide, please. So the first thing I wanted to touch on with this headline, the Swiss Central Bank cuts rates for the second time, underlying European divergence, is that there's a difference between what's happening with monetary policy in the US and in other parts of the world, such as Europe. Europe started to see more of a taming of inflation, and they're beginning to cut rates, whereas the US has remained cautious just in the face of economic indicators that point to persistent inflation. Next slide, please. In terms of, the predictions for the Fed's actions going forward, they left the Fed funds target rate unchanged at 5.25% to 5.5% in their June meeting. This was expected. Again, economic data just did not support a rate cut at that time. And rate forecasts are pointing to one rate cut this year. I am going to touch on this again in a later slide. Next slide, please. In terms of just other headlines that have been in the news a lot lately, will debt sink the American empire? This sort of touches on the indebtedness of the US government, with debt around 120% of GDP. And it's just garnering more attention in the media in recent times, given the increase in rates and the impact of those rising rates on the interest expense of the government. Any changes in credit ratings on U.S. debt or any actions on the part of U.S. debt holders to sell off their U.S. treasuries would have an implication for the agency debt market. Next slide, please. So this just outlines the topics that we're going to touch on today. I'm going to give a brief overview of global markets, as well as the agency debt market and recent funding corporation issuance activity. And then Dave will touch on yields and spreads, bank liquidity, and potential impacts on funding conditions from ongoing military conflicts. Next slide, please. So as I indicated, the Fed did decide to hold rates steady in June. I think since our last funding update back in November of 2022, rates have increased by 150 basis points. They were at 3.25% to 4%. Back at that time. So with strong economic growth and a tight labor market, these remain headwinds to further rate cuts. However, recently we have seen that growth did slow somewhat in the first quarter of 2024. Hiring and consumer demand is starting to slow. Those recent jobs data, which indicated a cooling job market, and then just today, there was a headline that inflation is starting to ease beyond expectations. So as we get more inflation data in over the next week or so, that should give an indication as to what the Fed is likely to do sort of heading into the rest of this year. And just to touch quickly on what's happening elsewhere, the European Central Bank did cut rates in June and acknowledged the potential for a couple further rates later this year. The Bank of England, they kept their rates steady in June just because they see the potential for a second round of inflationary pressure. And on the other end of the spectrum is the Bank of Japan, which ended 8 years of negative rates with their first interest rate increase in almost 20 years. In terms of the U.S. Treasury market, we've talked about the debt outstanding. So we're at 27 trillion as of June, and just to put that in context, U.S. Treasuries were around 3 trillion in 2000, and then they grew to 5 trillion around the time of the financial crisis. So in the last 15 years or so, they've grown to their current $27 trillion dollar level. An annual issuance of treasuries has nearly doubled since the pandemic, and there's just not a lot of signs of slowing down in spending. Another factor that's impacting, U.S. Treasury supply is the Fed's quantitative tightening. In June, they did reduce their quantitative tightening program from a cap of allowing 60 billion to roll off down to 25. So they are trying to put the brakes on slightly to limit the potential of destabilizing markets. An increase in the volume of U.S. Treasuries in the market could have a crowding out effect for agency debt. And then I just had China up here just because it's the second largest economy. They have been slow to recover since eliminating their zero COVID policy, and they continue to face various structural challenges. Dave's going to touch on the impact from ongoing military conflicts. I just wanted to highlight that there could be an impact on inflation from those conflicts through any disruptions to the global supply chain. Next slide, please. With this slide, I really just wanted to touch on the trend in longer-term debt. So this looks at the 10-year yields for various major economies around the world, and you can see a general increase in yields since the the rate tightening cycles over the last sort of year and a half. We did see yields come down a bit in May as the market anticipated rate cuts. Then they went back up again. It's just sort of very news driven as investors try to figure out what the Fed is going to do with rates. Next slide, please. With this slide, I just wanted to touch on the changes since our last funding update when it comes to the credit rating agencies for U.S. government debt. So the green text there indicates what's changed since November of 2022. Moody's downgraded their outlook to negative, and Fitch downgraded their rating from AAA to AA+. And these changes were largely tied to, again, the heavy U.S. debt burden, large federal deficits, as well as governance issues, such as the debt ceiling issue, which is going to arise again in January of 2025. Next slide, please. So just getting into the agency debt issuance specifically, you can see here that in terms of issuance, we're second behind the federal home loan banks. The nature of the FHLB's lending, they tend to issue more short-term debt, so you see more turnover in that debt, hence the higher issuance volumes. The system, we did see a decline in issuance in 2023, and that sort of tied into the increase in interest rates and the shift away from discount notes, as well as a decline in callable debt activity and not having to reissue debt that's been called. But our debt continues to be well received by investors, given its GSE status and mission and the consistency in our financial results. Next slide, please. And just in terms of debt outstanding, again, you can see we're second to the FHLB, and our debt constitutes about 20% of the GSE market. Next slide, please. And just to look in a little more detail, and this is debt outstanding, but it's broken down by the different types of debt. And the main story here is, again, the decline in discount notes as a percentage of overall debt, and the increase in floating rate bonds. You'll see that in the SOFR column. A sizable increase since the end of 2022. Next slide, please. Lastly, I just wanted to touch on the dealer group, and this is the group that's the primary distribution of system debt as well as secondary market support. So there are 34 dealers in this group as of June, and this includes 9 lead dealers, and these are firms that are owned by minority women and veterans. And they have broad access to system issuance, and that access is increasing. David's going to touch on that more in his section. And these dealers, they support the goal of further diversifying the investor base. So with that, I am going to turn over to David.
Thank you, Shar. Good morning, all. As she just pointed out with the lead dealers, we'll go into a little bit with the next slide. If you would advance it, please. Since we last spoke in November 2022, some of the things the Funding Corp has done to enhance the availability of debt securities for those lead dealers, and as well as to address some of the volatility that's been present in the marketplace due to the trajectory of the Fed's actions and kind of the data-driven, which way are they going? One of the things that they've done since that in that interim period is have introduced Dutch auctions, and again, this helps to address some of the issues relative to putting too much of a balance sheet in play and getting a specific segment that you can have a bid on, which enhances the lead dealers as well as the other dealers as well, but it enhances their ability to access those securities. And going down to the posted has been used. That process has been used for discount notes for an extended period of time, but they introduced that for floaters. Again, same aspect here, to help address the volatility in the markets, but also to help the lead dealers be able to get a portion of that security if they so do choose to. And those, as Char pointed out, the floaters, especially SOFRs, have been very prominent as this area of volatility. And again, with the some things we'll talk about in a little bit, the inverted yield curve definitely playing into that, and people's ideas on where they want to put their money for how long. Auction negotiated callables are still utilized for using that process, and again, that's something that's been curtailed somewhat. Callables, just because of the nature of them, and again, the rising interest rate environment. That process is done, but that has been a little harder sell, if you will. The callable segment. Reverse inquiries have grown, and that has been a product of the fact that we've had some fiscal policy that's between the Inflation Reduction Act and the Infrastructure Act have given state and locals proceeds that they need to invest, and that's where the reverse inquiry, those investors, if you will, come directly to the Funding Corp and say, I have a certain amount of proceeds I'd like to invest for a certain amount of time, specifically for a specific amount of time. And that function has grown for that because of that availability. Next slide, please. Just to give a little flavor for, again, this is just the discount notes, which Shar pointed out have gone down in the amount that they are of the portfolio, but they are still the most prominent as far as the issuance of debt securities because of their short-term nature for the system. And you can see here, based on the strata of who are the investors at the end game for discount notes, and that's pretty representative of all their products. It does vary based on certain types of debt securities, but this gives you a flavor for what they are. One of the things to point out is with the fact that the money market funds, investment managers are dominated by government funds, and that helps to the GSE market with the farm credit system being part of that. With $6 trillion in money market funds, that amount of money out there in play helps to promote these being very well received, and it's not just for the discount notes, but also for the regular other securities that are involved for the system. Next slide, please. Now we're going to spend a little time on this one. I mean, you can see again, putting our data points out since November of 2022. You can see in the middle there's the classic, if you will, with a humpback in it, a regularly sloped yield curve. Generally speaking, yield curves that are regularly sloped, financial institutions make their bread and butter out of that. Again, take it in short, lend it out long. That's part of the game of being a financial institution. Since that aggressive increase in discount the Fed fund rate by the Fed, we've seen an inversion of that yield curve. This is specific to the system, but if you look at the Treasury yield curve, it would be pretty much in line with that, except for the risk premiums that are involved. One of the things that's occurred with this inverted yield curve is the weighted interest cost of, as well as the increase in the overall interest rates, is the weighted average interest cost for the system. If you want to harken back to 2021, the end of 21, it was actually 0.80%. So taking that as a marker, I mean, in 22 at the end of that year, it was 2.78. Going to last year's end, 3.88. And as of March, it was 3.94. So again, you can hear a very market change in the amount of interest rate cost that's being paid by the and borrow it as it transfers down to the line. As far as the overall other aspects of that increase in interest, the net interest rate spread has been decreasing as you basically have a compression based on a number of factors. From the level at 12/21 was 2.33, and as of 3/24 it was 1.86. So the spread's compressing, but the system does benefit from its very sizable capital structure. And in that case, the net interest margin, which takes that into account, that capital being utilized, that has been fairly consistently at a 2.4 level, and it's gone up a little bit, gone down a little bit over that time horizon, but that's maintained a fairly static position. Next slide, please. One of the other aspects that we'd like to discuss today would be relative to the risk premiums. Again, this is above Treasury, and these are just for estimates for the bullet, if you will, the fixed securities that the funding corp puts out on behalf of the banks. You can see there's been a general favorable trend in this graph, as the 10-year still has a fairly sizable amount of risk premium associated with it. The system does most of its business though in the 2 to 5 year space. So if you look at the blue and yellow lines, that kind of is where their majority of business is done, at least from the bullets standpoint, and as well as the other ones as well. But you can see that with the isolated incidents that happened in March of 23, and we had generally speaking, there was a risk premium needed to be paid as investors became nervous at what was going on in the commercial banking sector, which we'll go into in a minute. Now, spreads that have trended down to being very favorable, especially toward the end of the time frame here, and with the 2 year and a 5 year product. Those are back to where they were basically before pre-COVID. So again, the GSE space, as Shara pointed out, the money market funds having limited options to invest in, they're chasing. There's more demand chasing less supply in the GS space, and that's helping to push those spreads down. Next slide, please. As we've been talking about the time horizon since November 22, we cannot go out talk about that without the March 2023 event. That was liquidity scare. Again, the increasing Fed funds rate and the impacts of that, and the 11 straight increases in the Fed funds rate, that and the prolonged inverted yield curve that we kind of just saw, and then I mentioned for the Treasury, that prompted some fixed rate investment portfolio losses. The aspects of that and some other features caused some sizable commercial bank failures. SVB, Signature Bank, and First Republic. If you wanted to do a size factor, those three together would be bigger than the system itself. So they were about 600 billion overall, and that would basically eclipse the system size factor. So in the space of commercial banking, where they talk in trillions, and you're talking JP Morgan, Wells, and Bank of B of A, that obviously is not quite the size factor that we're talking about for those individual banks. But again, that did cause a ripple, and that was both, in big part caused by the investments that they had, and the fact of what their fixed rate investments were being affected by the increased interest rate environment. The Federal Reserve Bank Term Funding Program stepped in to help alleviate concerns in that area, and that, again, the Fed came to the rescue, if you will, in that regard. Obviously, with COVID, there was a number of things the Fed's done, so they've kind of made a pattern of practice of coming into to not just their mandate of inflation, and jobs, but also to kind of quell uneasiness in the markets. Next slide, please. The days of liquidity for the system, we'd just like to point out some of these metrics. Again, liquidity is, as we just talked about, the liquidity scare is very important. In the case of the system, it's the backup for if they can't access the market, as they do have a sizable amount of capital, but daily access to the market is pivotal, given the amount of debt that they have coming due. And with these days of liquidity show that if they weren't able to access the market, they still have a way to pay the debt that's coming due, but also to fund funding needs if they were to occur. The unique thing about the system's debt liquidity portfolio is that it's not just for systemic issues; it's for actually individual bank and industry issues. So again, these are measures on regulatory metrics that are in our regulations, and those are well met by these individual banks. Which again, that's the onus is on each individual bank to keep its liquidity portfolio in compliance. Those liquidity investments were somewhat adversely affected, though, by the same thing that happened with the commercial banking sector, with the sizable increase in interest rates and the effect on those fixed interest rate investments, and bank specific on what their philosophies were. Next slide, please. Just wanted to touch on the ongoing military conflicts. Again, NATO summit is here today. Good luck to anybody that's having to traverse back to DC with the motorcade, mania that you might have to fight through. There will be I'm sure there will be a lot of blocked off roads and just just lines of dark cars and gentlemen with armament. But the global issues here, as we've already, the Ukraine has been going on for some time now, and there was some aspects of that are still kind of reverberating, if you will, between the cost of those ongoing conflict. In the case of the Middle East, we've had some issues with the ability to have commerce flow through the Suez Canal, and that may enhance the cost of goods as people have to reroute around Africa and what to bring goods into market. At those, as well as the fact that you could have, if things escalate, that hopefully won't happen, but you could have supply constraints on oil as some things are under attack, or there's some other issues that develop from transport. Again, those are potential economic shocks that could be in play. Again, escalation obviously would also be, in the case of probably investors, would be looking for safe harbor, which generally is good for the system and the treasuries, as they're viewed as some of the safest investments in the world. So that could push down interest rates, aside from what the Fed's doing. Long-term impacts, again, with those conflicts and the need to fund additional militaries, that's being kind of the way that a lot of people are addressing their concerns on what's going on in the global space. You have a certain amount of capital available for a certain amount of needs. Now, if you bolster military spending, then that capital is taken to do other things that you might be able to finance in the case of agriculture or what have you. But you have a definite potential for that to increase the cost of funding in that regard over the long term, with the deficits that it may cause and balloon. Next slide, please. So just to summarize, kind of between Shar and myself, what we've kind of been trying to convey. Overall, the system does have strong demand for its debt. Again, varies by type, given some of the volatility that's been experienced currently, and as over the course of the time horizon we've been discussing. The prolonged yield curve inversion, again, has some detrimental effects for any financial institution, including the Farm Credit System. And we've discussed that to a point. A good aspect that has come about during the time frame was that the risk premiums have fallen, and that, again, that's although interest rates are up, at least the risk premiums have been compressed to a certain degree that the system's paying over treasuries. Definitely solid secondary source of liquidity in the investment portfolio. Some deterioration because of those 11 interest rate hikes and the inverted yield curve. But generally speaking, the solid secondary liquidity in the system's investment portfits, the banks specifically, and then just the ongoing military conflicts and what could portend from those. At this point, I would conclude my presentation, and I would ask Shar to come back up for any questions that may be in play.
Thank you. That was wonderful. Does the board have any questions for either Shar or David? Mr. Hall?
Good job on the presentation, the briefing yesterday, and I have no question, Mr. Chairman.
Mr. Smith?
Just one question, our continuing high interest rates have contributed to the strong dollar, which has just kicked our ag exports in the teeth. And I think we're running probably one of the largest deficits, our ag trade deficits that we have in decades.
Mhm.
With prices heading to the dump on ag commodities, do you see any hope that our export situation would improve at all?
I would say, again, the Fed and what their take is on where they think the inflation is. I mean, as Char pointed out, there was a favorable report that came out this morning. And again, the fact that the Fed may be able to make a move in September, I mean, again, they're very data dependent, but it seems to be that they're seeing signs of what they want, plus the little bit of slacking in the labor market. So that whole strong dollar is a component. A part of that is because of the fact that the interest rates are higher here. So that if that comes down and that yield curve comes down, then that should help to make that dollar be a little less aggressively priced for comparatively speaking. So that'd be my, but I don't think the Fed's going to be taking things off the top at 1%. They're going to be, I think, given what they had and what happened with their idea that it was transitory, and then we had this this 9% inflation. I think they're, if you will, they're once bitten twice shy. They're going to be very, I think, very cautious in taking the interest rates back down and then letting inflation basically return.
I don't have any questions. So if there are no further questions, thank you for your presentation. Please turn to the adjournment tab. If there's no further business to bring before the board, I will entertain a motion to adjourn the meeting.
Mr. Chairman, I move that we adjourn the meeting.
Second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Mr. Hall?
Aye.
Chairman Logan?
Aye, the motion carries. The meeting is adjourned.